Don't go anywhere, guys. This is an important one. We're looking at the state of world capital markets for M&A activity, transactions, deal flow, buy side, sell side, and we have a table of contents here, starting with a market overview, because any serious person who works in investment banking or private equity or anybody who does deals, we got to pay attention to what's going on in public world markets. So we're going to start there. There are timestamps if you want to skip ahead, if you don't care what's going on in the S&P 500, the yen carry trade. If you don't care, fine. Skip ahead. Timestamps below. Table of contents is here. Private equity, private credit, alternatives. We'll look at some hedge funds. We'll look around. We'll look at some miscellaneous intriguing items, things that caught my attention in the past week. We'll look at precious metals and commodities. We'll look at gold and silver, a couple of mining companies that have declared their earnings, if they're worth any exposure in your portfolio. And then we'll get to Bitcoin and cryptocurrency at the end. And remember, guys, keep this in mind. We're looking at this from the framework of what is going on out there and what do I need to know if I'm on the buy side, if I'm on the sell side, or if I'm the business owner and I want to pay attention to what's going on with tax rates, what's going on with capital or liquidity conditions easing, is it things getting tighter, are yields going to go up? All these things matter, buy side, sell side, or if you're the business owner, if you're the person who's thinking about a strategic exit or taking some chips off the table, all this stuff is relevant. Okay, so this is our quarter 3 outlook for capital markets here in the second half of 2024. All right, thank you for joining, and now we're going to jump in. The volatility index futures are still in a period of backwardation. What is backwardation? Well, for anybody who's traded natural gas, who's used KOLD or BOIL, cold or boil, they call it contango when the price goes into a backward effect with volatility. For some reason, I don't know why, it's called backwardation. What it means, the price of the index is higher in the near term than the sequential term. So this was a Friday at close, 19.59 for August future, August 21st. A month out, September 18th, 19.03. So what is that? 56 basis point spread. And then another one, almost a point and a half. Oh, that is a point and a half. 20.58 for October and 19.07 for November. Okay, we saw this in March 2020. This showed up around the end of February in 2020. Before the world realized there was a pandemic, volatility backwardation showed it to you. This is pretty startling. If you closed your long portfolio every time you see the VIX backwardation show up, you would avoid every market crash ever in history. This has begun to normalize. We did a video about it a couple of days ago. We've been looking at this, and we're going to look at a proxy for credit spreads. So this is becoming more normal. We think we're in a volatile regime, but the unwind, at least the partial unwind of the Japanese yen carry trade and everything that went on over the past week, we think that's going to go away. We don't think we're going to get another severe crash from here. But this is still something to be aware of. You want to see the spread narrowing and normalizing. All right, so we're going to be watching for that. And now let's look at credit spreads. This is the proxy I like to keep an eye on for credit spreads. You could get more granular if you wanted to, but here's the one I use. You can see it in the top, or comment below if you want to see what I'm looking at. This one, BAML, you'll see it. Anyway, the near-term trend line was broken here in green. The longer term in white, we went up there, we rejected it, and we're coming back down. So let's really zoom in and see. Solid rejection here around 3.92, and we've come all the way down about 44 basis points now. So that is encouraging. Let's expand the time frame here from the daily to the weekly. You can see now we're not quite at these secular lows from back in the day here when things normalized in 2021 before we had you guys remember 2021 when things were shooting to the moon. We were making good money then. And then 2022 came, whoosh. We seriously, shit hit the fan there. So we're not quite back down to secular lows, but this long-term trend from when we started raising rates in 2022, we're still below it. So let's go back to the daily and just zoom in here to see that one more time. That is a pretty serious rejection. Okay, so it looks like this trouble is over, and now we're starting to actually even melt back through these EMAs. So the this is the 8 here in yellow. It's pretty weird to do technical analysis on a credit spread, but here we are. We want to just see this melt back down and come back down to the low. Under this green line would really be wonderful. Okay, looking at the last 5 days, you guys are gonna laugh when you take a look at this. But let's start looking at we got the Nasdaq, S&P, the Dow Jones, the IWM small cap index. We put TLT, the long bond, in here. I put Japan, EWJ. I put the Invesco commodities index just to get a sense of what's going on there, and the U.S. oil fund to see if the inflation trade might be back on. Now, let's look at Japan first. So it started down here. I mean, down like 5, 6%, down like 10 or 20% last week at one point. So this is pretty crazy just to look at how it's clawed all the way back. And then in between Tuesday and Wednesday, when there was that intervention, it was down 3% and then it opened up 2%. The 5% gap up when Bank of Japan was like, okay, hold everything. So this is pretty interesting. But to see that in a week where everyone starts to feel a little bit bold back up that everything is good again, one thing you can track is the inflation trade is back on because of intervention. And how do we know that? Well, look at US oil up almost 4%, commodities fund up 1.4%, the long bond yields coming down, or sorry, yields coming back up as inflation expectations go higher. So, yes, markets have been stabilized in the past week or so. No, volatility is not gone, and no, the inflation trade is not gone. At least in these past 5 days. But now I'm gonna make you guys laugh. Check this out. If you put volatility on this same chart, look at how skewed it gets. You know, just a moment ago, you could really see the spread, but what is going on here? Well, when the week starts with volatility up 130%. But look at this. This is truly historic stuff. Look at where VIX closed. VIX closes the week down 13% from up 130%. And look at how goofy this chart looks. That is truly something. Okay, now looking at the sectors and the categories. So another one that looks kind of funny, down like 8% to open the week were the semis, and then they closed the week up 3%. I mean, oh, what can you say? Um, Growth is back in the picture, but XOP, some oil stuff, energy XLE is up there too. I mean, I don't know. Not a ton to infer from the past 5 days, except that we had crazy week. Now, things that are possibly more interesting to us folks in the private world. Um, Good week for Argentina and Brazil. Brazil, another commodity net exporter, so good to see. I'm a fan of Milei down in Argentina. I think that guy's funny. So good to see what's going on in the Americas. The Asian markets and the Pacific there with Australia. Japan, of all countries, to close 1.1% on the week. My goodness, what a rally. Taiwan, Hong Kong, China doing decent. South Korea down. Europe, not a great week. And you get a lot of mixed signals, but Israel up there and a good private equity, good capital markets in Israel. Um, Turkey has its own troubles, but good to keep things in perspective on this side. Another one that's going to make you guys laugh. So I'm a fan of saying if you do the opposite of what the mainstream media tells you to do, you're typically going to do pretty well. So CNBC did its markets in turmoil, and Charlie Bilello, I don't know if I'm saying his name right, did the S&P 500 forward total returns following one of these segments. Let me get this out of the way. So 1 year forward returns from every time they've done it. Oh man. So when everyone's panicking and selling because the folks on the TV tell them to, that's when you should be buying. That's the takeaway. But this data set is from 2010 um, to about 2022, and we've had ZIRP, the zero interest rate policy, and a lot of central bank intervention since then with negative real rates. So take it with a grain of salt. But still, I looked at this and I was like, oh my goodness, that is hilarious. And we talked about the inflation trade being back on, but we're looking quarter to date here. So today, August 10th, it's about 3:15 Pacific time as of right this exact moment. So the past 40 days or so is what we're looking at from the beginning of July until now. I see deflation. You can look at the indices. Okay, that's pretty clear there. Gold being up, on the one hand, you want to say that that's tracking something or it's a warning sign or whatever it is, but I see that as rates are likely to come down. Central bank intervention is necessary. There's so much macroeconomic, political risk, there's political instability and uncertainty, so I think some modest exposure to gold makes a lot of sense. But we're going to get into this when we look at precious metals and that space toward the end of the video. But I mean, pretty clear here. Agricultural commodities are down, energy commodities are down. And we're going to talk about this as well because it's coming up on hedge fund exposure is as short as it's been commodities, and I can't remember how long. But this is going to be important because there's something I want to highlight here. What does a hedge fund do? A hedge fund is a hedge, right? You're not putting your entire life savings, you're not allocating 100% of your portfolio into a hedge fund. So think about this scenario. When you're looking at the positioning for a hedge fund, you have to keep something in mind. Okay, let's say I am some type of enterprise farmer. I produce agricultural commodities. I produce wheat and sugar and corn and soybeans. And I also have a lot of energy. I have wind turbines. I do some exploratory oil and gas partnerships and drilling programs. So my revenue is based on these literal commodities being sold in the spot market. Okay, so there you have it. Now, if I'm giving my money to a hedge fund, what would I want them to do? Well, how am I going to be hedged? The way that I would be hedged is I make money when the spot prices of these agricultural goods and energy services and these other items get sold. How could I hedge that position? Well, I need a hedge fund to short these items, but it's treacherous and complicated, and you lose a ton of money if you don't know what you're doing if you're in these agricultural futures markets. I mean, just look at the parabolic moves in things like cocoa or coffee beans. People can really get blown out of the water in there. So in that scenario, I'm giving my money to a hedge fund and they put on a massive short position of commodities. Then it shows up on Twitter, hedge funds most bearish they've ever been on commodities. You have to think about the perspective of who's giving them their money. You have to dig underneath the hood to figure out what is the strategy of that hedge fund and why they're doing it. So it's a little bit of an aside, but just something to keep in mind when you're looking at data and people are presenting things to you a certain way. They're typically trying to sell you something and to get you to have a certain type of reaction. So take everything with a grain of salt. Now let's dive in. Let's look at what's going on in the world of private equity, private credit, hedge funds, and other types of alternative investments. We're looking here at some data from PitchBook. We've got Apollo, Carlyle, KKR, Blackstone, TPG, and Blue Owl here. I just like these graphics. They're really easy on the eyes, easy to understand. Distributable earnings. Blackstone is larger, so obviously they get more earnings, but we can look at their stock performance. And there's an interesting one here. KKR trending upwards. And in the past couple of months here, Apollo trending upwards. Blackstone is chopping sideways, up, down, and all around. Carlyle having some difficulties. And TPG and Blue Owl, their stocks are not trading publicly just yet, but seeing some divergence. So that's interesting. But the trend for the 5 years that they've been trading, if you bought when they first got in, you're still making money. So that's good to see. AUM is growing, fundraising. So let's just try and look at the trend here. Anyone who remembers 2021, hell of a year. We miss those days. 2022, still a decent year, and then it's been falling off. But are we plateauing here? If so, 2023, still better than 2020, better than 2019, better than 2018. So, as my boss would say, reversion to the mean. But this time, when you mean revert, since we are always going up and to the right, now that we're getting to the mean, we're going to be higher than we were. So this is good. Exits from the quarter. CVC big time, 15 billion with Blue Owl Capital, Viking River Cruises, and then some smaller guys, KKR, Blackstone getting in on the action. Decent stuff to see. Now let's take a look here. And this stuff, man, they're elite. They do a wonderful job of pissing me off. It's always we always do something wrong for trying to get in on the action. Yeah, sorry for trying to participate in the free and fair market. Private credit firms boxed out of M&A deals by banks as lending battle escalates. Okay, interesting. Okay, so JP Morgan kicked off the sales process for carriers' fire prevention business earlier this summer. Buyers were welcome to poke around the company's finances. Their lenders were not. Private equity bidders weren't allowed to share data with the private credit shops that have increasingly become the go-to source for the buyouts. So yeah, I mean, if you're trying to make an exit, you just want the best terms and conditions, the best deal structure, right? But what is it all about? Well, obviously, at stake is supremacy in a $1 trillion lending market. Private credit funds have raised huge piles of cash to horn in on banks' territory. It's like a turf war. They try to make it sound so dramatic. Like, bro, all that's happening here is people want to work with the best people. You get to a point where you're involved in an M&A. It's on the buy side or the sell side, whatever it is. You want the best advisory team and you want the best deal structure for the transaction. That's all. If it's a bank, if it's private credit, I've never spoken to someone who is like, I want to exit, I want to do a minority deal and take some chips off the table. But I'll only do it if it's with a bank. Like, no one thinks that. But anyway, let's see if they have anything else here that I wanted to share with you guys. Not a ton, but private credit firms like Blackstone, Ares, Blue Owl see self-interest. Fees for financing a buyout can dwarf the fees for advising on it. It's okay, sure, self-interest. Do you want to do a ton of work for a little bit of money or a medium amount of work for a lot of money? You ask anybody that question, it's like there's a difference between acting with self-interest and just doing what logically makes sense. And no one's forcing anyone to take the deal. If they're bad at it, they should be boxed out. But you can't box them out because they're trying to provide a valuable service. That's not how anything works. Um, so anyway, okay, so I don't want to get too in the weeds here, but the point is there is activity picking up and private equity firms are getting in on the private credit action. And this is not a bad thing, but for anyone who's in the space, just, keep an eye, keep an ear to the ground. If someone is offering you a good service and you have a good advisory team to look after, give you second, third, fourth pair of eyes for the accounting side of it, for the legal side of it, you name it, getting a phone call. Um, Go ahead, don't just say, oh, well, Blackstone, I heard they're a private credit, so I don't want to work with them. I mean, come on. Okay, that's good there. Now, let's look at what's going on in the alternative world for the month to date. Let's get the head out of there. Month to date. Try to focus in on how these things are performing relative to the S&P 500. So let's look specifically at hedge funds and private equity in the quarter to date. So the past 40 days or so here on August 10th, um, outperforming the S&P. And this is an important point with hedge funds and private equity in particular here, because there are times when having exposure to alternative investments is beneficial to your portfolio, particularly if you're not under lockup provision and you could now flip the proceeds from the capital gains that you're making elsewhere back into stocks and bonds or whatever else. It's just another tool in the tool belt to help you rebalance to buy low and sell high. So we've experienced all this volatility. Hedge funds, private equity have outperformed the S&P. That's good. You want that in your portfolio. Um, which is not to say, if you had small cap value during this time, or if you flipped your growth and momentum stocks into small cap value, then sure, you did a great job. I'm not saying that you shouldn't do that. I'm not saying that that was wrong. I'm just saying helpful to have exposure to other non-correlated diversified assets to help you rebalance effectively. All right. Now, just looking at some headline news, private capital group hit and hope groups. Okay, I can't read. Private capital groups hit and hope in rush to deploy billions. So this is good. There's been a volatility problem in markets, but Blackstone and other groups are deploying capital. That's healthy. Record 34 billion private credit fund at Ares. So obviously there is a lot of demand for the private credit asset class. Good to see. 160 billion preparing for deal revival. Ares, Apollo, Blackstone, KKR prepare to increase buyout-linked investments as interest rates ease. Yes, let's go. Okay, so this was a week ago. 160 billion being deployed. All right. So if you're thinking about taking a few chips off the table, this is when you want to do it. Do it during the gold rush. All right. And then, of course, you'll always be deterred to work with the private equity groups because I don't even know who put this out. I just saw it and I was like, does this look like a bubble? No. More assets over time doesn't automatically mean it's a bubble. This is like the laziest analysis of all time. It's like if I show you the S&P 500 worth like 10 points in the 1800s and now it's like 5300 and I'm like, does it look like a bubble? No. It goes up and to the right over time. That is not a bubble. What else going on? Private credit. Goldman Sachs is giving select clients access to one of its hottest businesses. So note how Wall Street Journal, buddy buddy with their friends at Goldman Sachs, some of these central bank type players. So when Goldman Sachs is allowing people to participate in private credit funds, it's, ooh, you get access to the hot business. But when Ares and Blackstone have a private credit fund, it's a bubble. Get out of here with that type of the manipulative language. Let's see here from Bloomberg. Private credit fund in the works at a Brazilian asset management firm. So this is kind of cool. Sul America Investimentos planning a project financing fund. They're increasing their cash position, starting a real estate fund. Okay, so good to see the democratization of these asset classes, not just in America, but around the world. Now, I was talking about this a moment ago. When you see these type of headline news, if you didn't catch me rambling about commodity prices month to date and saying, careful when you see prices are down or when prices are up, down, and all around, and you see something like this doesn't necessarily mean what you think it does. They could be hedging a long portfolio. They could have a lot of energy plays. They could have a lot of oil and gas partnerships. I mean, you just don't know what is on their books, and that is what they're hedging against. You don't know their break evens. You don't know the mathematical modeling. So, and you don't know how the math lines up to their risk reward profile. So this could get unwound. Commodities could go higher, they could go lower, but just be careful when you see stuff like this because a hedge fund is they're using a specific strategy to hedge something. I mean, it's right there in the name. So it might not be the case that they all are saying there's definitely going to be a recession. It just could be the easiest way to profit from economic weakness while hedging and maintaining their long positions. And speaking of hedge funds, I like Bill Ackman. I think it's kind of cool the way he's gotten all involved and active on Twitter and stuff. And I'm not saying that sarcastically, but I do think this is kind of funny. Like, hey, brother, if you focus more on managing money, which is what you're supposed to be doing, then you wouldn't have to delay your IPO, abruptly canceled. Let's see. Pershing Square Capital Management confirmed the cancellation, but did not provide detailed reasons for the decision. After careful consideration, we have decided to cancel the IPO of Pershing Square USA. Remain committed to our investment strategy. Da, 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 da. So, uh-oh. Now, last thing, secondary funds. So here's one. This is Flowstone Partners. That's not important. Well, it could be if you're interested in a fund like this. But here is their net IRR percentage, looking at buyouts, fund to funds, venture. Secondaries has the best performance. So we're talking about a secondary fund as, call it, let's say this is like a pitch, why you would want to have a secondary. Shorter holding periods, discount to purchase price, ability to compound return multiples through reinvestment of the proceeds. And they have historically outperformed an index of traditional private equity and VC funds, while also not as volatile. Okay, so the standard deviation only around 13%, 18 for buyout, 23 for venture, and we've been between like 15, 17% for the S&P 500 these past couple of years. So less volatile. And when you have a secondary fund, less risky than a venture capital that, they'll invest in 100 things, and if one of them turns out to be a unicorn, they make a ton of money. Secondaries are not the same way. They're battle tested. When they buy in, they're getting in at good valuations for funds that are, or not funds, but for companies that are pretty safe, which you will see here. So when we had COVID in blue, when we had the global financial crisis in purple, so this is 2020, COVID 2008-09 for the financial crisis. Look at secondaries. Down 6% for COVID, down 5% for the financial crisis. Whereas the S&P down 20 and down 46, the MSCI World down 21, 22, down 50. So if you think volatility is going to remain problematic and you want to diversify your portfolio, this is a great way to do it. And like we saw, looking at when there are periods of outperformance, you have an opportunity to rebalance, particularly a fund like a secondary fund where you have redemption capability every so often. It's not like a 2-year, 5-year, 10-year lockup. It's just another way to diversify and rebalance your portfolio. So there you have it. Now let's move on to the next section. Moving into the miscellaneous part of the video. This doesn't really have to do with anything, but did you guys see this? This is the coolest thing I've ever seen in my life. Man, that is absolutely brilliant. Such a cool edit. Are you kidding me? The guy from Turkey with the Swedish shot. Ooh, into the beer. Legend. This is something I've been keeping an eye on. I think it makes a lot of sense for the businesses that have left California and gone to Texas. That is not just Elon Musk companies, but now Chevron has done it, Hewlett Packard, Oracle, a real estate company, Charles Schwab. The cost cutting, the tax savings, it makes a lot of sense. Elon is citing the political side of it. But anyway, for what does it mean for you in private equity or managing your own corporate or personal finance? Something to keep in mind, we do strategic advisory services if you want to reorganize your business, or if you're thinking of moving your business or moving the headquarters of your business. What does it look like in a different state? We could financially model that out for you. We've worked with clients working and living abroad as well. So, I just thought it was worth mentioning since it is sort of this hot topic. Elon Musk taking his companies to Texas, Chevron going to Texas, and you're thinking, is that something I should look into? Well, if it is, then, hit us up. We can chat about it and run a complimentary analysis for you. No one in the financial world cares about precious metals, right? Oh yeah? Well, I got something to tell you. I don't care how good Apple stock performs over the course of my lifetime. I can't wear it around my neck, you nerd. All right, precious metals always matter. If they didn't, then why would they be handing them out at the Olympics? Okay? And you wouldn't get this absolutely the cutest moment of the Olympics when this gal, I believe from China, she looked over and saw them, when they bite the medal. "Ah," like you're supposed to do when you win. And then she's like, oh, and then she does it too. Adorable. Okay. I love precious metals. I know I can look at a chart and understand that the S&P 500 is a better hold for me. I'm going to live for 50 more years. Why would I buy and hold gold? Well, I'm not buy and hold. I'm wearing it, baby, and I like it. All right. Deal with it. Now, you might have seen something like this parading around on the old internet. Gold versus the price of silver from 1971 to the present. Typically, as gold goes, so does silver, or vice versa. As silver goes, so too does the gold, baby. But it hasn't happened with this most recent rally. Silver has got a lot of catching up to do. And when silver moves, baby, silver can move. It's hasn't held that $30 spot. It's down to 26, 27 right now. All-time highs around 50. If you nominalize that and CPI inflation adjust it, we should be in 70, 80 bucks, maybe 100. Ooh, baby. Silver hasn't gone yet, but I don't think we're that far away from the jaws closing here. I can't believe I had to get onto my LinkedIn to find this, but I couldn't find this a second ago. So looking at the real, just so you can see it, real annualized returns, we've got nominal return, CPI adjusted, and what is the blue one? The real total return. Okay, so I just said this a moment ago. Obviously, if you're going to be buying and holding for a substantial amount of time, And what is this, by the way, from 1975 to May 2024? Okay, so obviously S&P is better. Real estate is not far behind. Investment grade bonds, and then gold doesn't do the trick. But buying and holding gold as a strategy does make sense from time to time. Now, here is the case that I want to make. US family offices, about 1% exposure to commodities. So let's say you have 1% exposure. Let's say it's all in gold. Do you think it might make sense to increase that to 2 or 3%? Okay, it's not a huge ask. You could rotate profits from the tech side, or maybe if you're in bonds and yields, there's a lot of risk there. Rates are coming down, and between geopolitical risk internationally and not even domestically, there is some turmoil between Trump and Kamala, and whatever comes with it. Uh, we're in wars right now. There are a lot of dynamic elements in play where gold tends to perform well. Okay, so think about this. Do they need to print more money to finance war, to endowments, pensions, all this stuff, healthcare, whatever? Yes, they do. Are rates coming down? Yes, they are. Are they going to have to monetize the debt at some point here? Maybe not tomorrow, maybe not next month, maybe not this year, but at some point, yeah, they're going to have to monetize the debt. Is there geopolitical instability? Yes. Are there risks out there that, whether or not they come to fruition, give people the reason to increase their exposure to something like precious metals? Yes. Okay. So we could make a lot of lists. The point is, if you have 1% exposure or 0% exposure, let a family office build a position for you, whether it's in precious metals or in some mining companies that have good leverage to the spot price. Um, it's never the case that you have to flip your entire portfolio into it. But would it make sense to have a little bit more exposure? Maybe it would. That's up to you to decide. Um, I made this chart a while ago, so the point ultimately was about, if you want exposure to commodities, broadly speaking, you're best to be in an index, because it's hard to pick which one is going to do it. This is like palladium, the purple, the blue one, cocoa futures have been really going crazy. Gold is up there around third place here. If you're only going to hold one commodity, probably gold is the one that makes the most sense. But if you like to get fancy with your commodity positions, I like to hold a Brazilian index, for example. If I think a net exporter of these types of minerals and energy materials and the like. But this is the chart that really, I mean, it speaks for itself. You don't really have to be a chartist, but when we had this inverse head and shoulder, so shoulder, head, shoulder, breakout, boom, parabolic move. That was from about $10 to $50 for silver. This giant cup, this giant handle, again, shoulder, head, shoulder, and it wants to go again. And nothing's really changed for me. This is a very long-term chart. I made this like a month ago. I don't remember when, but and when silver goes, so does gold. So this is silver and gold. As silver to gold ratio increases, eventually you just get a parabolic move. You get a parabolic advance. When silver initiates the move, gold goes too. Um, the silver to gold ratio is starting to pick up some steam. In the past few weeks, silver has been smacked down from like $32.50 down to like 26, 27. So obviously not what you want to see. But as silver goes, so does gold. So if you start see silver moving, it won't be too late to increase your exposure to gold. So this is not something you have to do immediately by any means, but one that it should be on the watch list. And we're talking about like a percentage or 2 percentage points of the portfolio. You know, it's a I can't think of a really, really compelling argument not to have it. And it's just because it makes sense right now, tactically and strategically. And ultimately, we're probably going to flip the position. And it's going to be a chance where we buy low here and we're going to sell it high later. And we're going to use it to rebalance into other things we want to buy and hold for the long term. Because we're not holding this for the next 50 years. Unless you just want to have some sweet gold around the neck, in which case there's never a wrong time to do that. All right, looking at the price action from the Bitcoin space, this is 4:08 p.m. Saturday Pacific time, Saturday, August the 10th. So it could have changed by the time you're looking at this. But holding above 60,000, we were below 50,000 just what, hardly 5, 6 days ago, as the yen carry trade of about a week ago spiraled into the weekend, panic selling, and that's classic margin call behavior. And Bitcoin actually served its purpose because it's 24/7 market. And when you have, when you get a margin call, it's not like, well, let me get back to you. It's like, okay, well, the market's not open. I can sell my Bitcoin and I can cover the position and blah, blah, blah. And the way that it's rebounded is constructive. So, let's start by saying that its rebound has been constructive. It has shot up off the lows and it looks to be in a decent spot here. You could say the same for just about all these other coins, but for the most part, I'm focused in on Bitcoin. And now let's hop over to the charts. Now, with Bitcoin, and I just did this rant about your exposure to precious metals and commodities being 0 or 1% on average or in other family offices. Bitcoin is probably the same thing. If you have no exposure to it, consider having 1%. Okay, so this is not like get out of equity, get out of bonds. I'm not going for the Michael Saylor micro strategy approach here. I just think it makes sense to have some exposure to it. You can talk with your advisory team how much exposure makes sense for you. But this is a good way to get something that is diversified, non-correlated. It might be a hedge against market insanity. It tracks the M2 global monetary supply of money pretty well. So if you think they're going to have to put the printers back on. But I mean, just to look at it, should I buy now? Should I wait? Is it going to go lower? Well, right now it's just a gigantic bull flag. And let's expand this, make it a weekly chart just to get a little bit more time frame here. Yep, just a giant bull flag and a bull flag around its previous all-time high. It's hard to be bearish there. This giant wick, hard to be bearish there, holding above some of its EMAs, but it's below the 8, 14, and 20. So, maybe there is some downside pressure. But let's look at it on the monthly too, because when you just get it into this perspective, I feel like it's very, very hard to be bearish. And I'm not trying to make a sales pitch here, but here is your previous all-time high. Let's just put like a shifty little line like right around here. And just say like around that area. Okay, so I didn't get it exactly right, but it was a little bit higher. At least, you can move it up to where these wicks are. But we're consolidating and forming a monthly bull flag at its previous all-time high. Hard to be bearish. I don't know what your argument for being bearish would be, and it's above the 8, the 14, the 20, the 50, the 100, the 200 for on the monthly. So, I mean, I don't know. I'm just going to keep repeating myself, but let's say you're in a 60-40 allocation right now, or let's say you don't have much investment and you're very heavily exposed to your own business. Let's say, you're the business owner. Does it make sense on your personal balance sheet, on your corporate balance sheet? Should you have a couple percent, 5%, 10%? These are the conversations you should be having. And someone who's not going to give you this rip-roaring sales pitch about Bitcoin to $1 million because it's just not productive. It doesn't help anyone. You can make those sexy arguments and good for you, but I mean, I don't know. That's not the business that I'm in. And then, if you do want to do some charting, I was pretty excited about this breakout back when it happened above this yellow line. And, then it looked like it was plunging and it was like, oh no. But actually, when I drew this out further, it was basically just a retest of the breakout. It's just got this weird sort of looping volatile breakout retest. MACD curling, RSI, a little bit of a bullish divergence possibly here, a little bit of indecision here, but yeah, I mean, here we are around $60,000 before rates are coming down. We think the Fed is going to start cutting. We think they're going to have to monetize the debt. If Trump is elected, we think the capital markets are going to explode, and the crypto vote is apparently now a voting block. So, I mean, this asset class has staying power. It's not going to zero, like some people like to say. Now it has inflows in it in a BlackRock ETF. People are getting exposed to it either through the Bitcoin ETFs or they're getting Bitcoin off of Coinbase. for the average person, and frankly, for almost anyone, I would say to avoid the Bitcoin miners. You can get leveraged to the spot price of Bitcoin through doing that, but I don't know, just a little bit too much risk for me to make any suggestions to clients like, oh, you really got to own Clean Spark or whatever it is. Not to say that they're bad investments, but if we're building a portfolio construction, having some exposure, meaning literally if you have 0% exposure now, should we increase at half a percent, 1%, 2%, 3%? We're not doing Michael Saylor here and sell everything, remortgage your house, buy more Bitcoin. This is not what we're doing here, but we do think, sure, let's get some exposure to it and let's see what happens. And there you have it. That is all for now, and we will see you again next time.